It's time to start cutting interest rates. At least that's according to the Federal Reserve Bank, because just yesterday, Jerome Powell, who is the chairman at the Federal Reserve Bank, gave a speech where he said, quote, "The time has come for the central bank to begin lowering interest rates." He says that now it is the time because number one, inflation has fallen, and number two, unemployment numbers are going up, which justifies the Federal Reserve Bank to start stimulating the economy through lower interest rates to get people to start spending money again. But don't just take my word for it. Let me read you exactly what the Federal Reserve Bank chairman said. He said, quote, "Inflation has declined significantly, and our objective here at the Federal Reserve Bank has been to restore price stability, meaning to bring inflation down, while maintaining a strong labor market, meaning keeping unemployment down, avoiding a sharp increase in unemployment that has characterized earlier disinflationary episodes, meaning in the past, if you look at the last number of decades when the Federal Reserve Bank has raised interest rates to fight inflation, what happened? We'd see a recession, we'd see unemployment jump. The Federal Reserve Bank chairman is saying he wants to avoid that this time around, although the task is not complete. Inflation is still around, but we have made a good deal of progress towards that outcome of getting inflation under control. Now, because of inflation coming down, because unemployment is going up, this is why Jerome Powell says that it is time to start cutting interest rates as a way to not let the economy get any worse. And this is where we have to understand, what are the consequences of this? How will this affect inflation? How will this affect the economy? How will this affect the job market? And how is this going to affect asset prices? Because your job as a financially savvy investor isn't just to predict what the Federal Reserve Bank is going to do. I mean, every single person has a financial opinion when they're kind of like armpits. Everybody's got a couple financial opinions, and some stink more than others. The important thing for you is to understand how this affects the economy and markets. That way you can find the opportunity here to build wealth. So let's start with the most basic, which is when the Federal Reserve Bank cuts interest rates, what is the first thing to be affected? Well, the Federal Reserve Bank interest rate is not your mortgage rate, it's not your car rate, it's not your CD rate. It is called the federal funds rate. And this is the interest rate that banks pay each other when they lend each other money. You could think of it kind of like the wholesale price that banks pay to borrow money. When banks borrow money, they pay this federal funds rate, and then they jack it up, and then they lend you this money at a higher rate. So now, if you were to put your money in the bank, whether it's in a high yield savings account, a regular savings account, a certificate of deposit, CD, now those rates are going to fall. So if you have a high yield savings account or a regular savings account, you can expect that if the Fed starts cutting interest rates, that the interest rate that you get is going to fall. So if you're sitting on cash, not so good news. However, if you already have money in a CD, it wouldn't be affected if you've locked in that rate. But if you want to get a new CD, the new rates after the rates get cut could be lower. The second part is, how will this affect money that you borrow? Because if you have a 30-year fixed rate mortgage, none of this really affects you because you have a fixed rate. But if you want to go out and get a new mortgage, you want to refinance your mortgage, or if you have variable interest rate debts like a credit card, well, now these interest rates matter because it can impact how much money you have to pay in interest every single month. Now, this is something that we've been covering in Market Briefs. Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the economy, the stock market, the housing market, crypto, and the global economy into a fun, witty, and easy to read newsletter. You can read Market Briefs in less than 5 minutes every morning, and it's completely free, and I promise you're going to love it. And you might say, well, Jaspreet, how can you promise that? Well, because if you don't love it, you can unsubscribe at any time because it's completely free. So if you have not joined Market Briefs yet, I got the link to how you can join down in the description below. But if mortgage rates get affected by this, which they very likely would, that means that mortgage rates could go down. Your car loan rates could go down. Your refinance rates could go down. Your credit card debt rates could go down, which the purpose behind this is to stimulate spending. Remember, the reason why the Federal Reserve Bank cuts or raises interest rates is a way to control spending in the United States because we live in a spending-based economy. But not just that, we live in a credit-based economy. Because if we just lived in a cash-based economy, what that means is if you made $50,000 this year, the maximum amount of money that you could spend is $50,000. But that's not the way that our economic system works. Our economic system runs on credit. So now let's break the system down that we understand how this will affect different parts of our economic system, because our economic system runs on spending. The more money you spend, the more money somebody else makes. If you make 50 grand and you walk into the Gucci store, well, now maybe you can buy a wallet or a purse But if you can open up a Gucci credit card, well, now you can buy 3 wallets and 3 purses. You can buy more stuff, which grows their business, which grows the economy, which can mean they can hire more employees and grow even faster in the short term. The problem is when you have these credit-based systems, is they go through these booms and busts. Because when people can take on more credit, then the economy can grow even faster. Because now people have the ability to spend more faster than how their income can grow. Because if your income is growing by 3% a year, you can only spend 3% more a year. But if your credit ability, your credit worthiness grows even faster, well, then you can spend even more money, which grows the economy even faster. Well, one of the things that impacts credit ability, credit worthiness of people is interest rates. Because as interest rates go up, your borrowing power goes down. Why? Because you have to pay payments on the amount of money that you borrow. And if the cost of borrowing $1,000 is going up, that means your payments on that $1,000 that you borrow goes up as well. So borrowing $1,000 is more expensive when you have higher interest rates versus lower interest rates. And this is where what the Federal Reserve Bank is looking at is how our economic system is doing. And what we've been seeing is that the economy has been slowing down. We've been seeing unemployment rise. We've been seeing a shift in spending habits. What does that mean? People are spending less money because they no longer have credit ability to spend, and they're being tapped out on their savings, and they've spent most of their earnings because inflation has been so hot. So people don't have the ability to spend the way that they did before. People have seen unemployment rise, and this has created a slowdown in the economy. While inflation is still around, we're not at the 2% target that the Federal Reserve Bank wants. We're not at 0% inflation, which is what many people would want. And we definitely don't have negative inflation, which would help reverse the big price growths that we have seen over the last number of years. So we still have this inflation around. And this is where the Federal Reserve Bank is taking a look at all the things that are happening in the economy. And now they're saying, well, it looks like there are risks of an economic slowdown. There are risks of higher unemployment coming, and we don't want that. And to prevent this pain in the economy, what are we going to do? We're going to start cutting interest rates, which means people can spend more money. If you've heard my videos over the last couple of weeks, I talked about Home Depot and Lowe's. Home Depot and Lowe's said the same thing when they released their earnings statements. The CEO of Home Depot and the CEO of Lowe's both said that the customers at these companies are waiting for interest rates to get cut. That way they start remodeling their kitchens and bathrooms again. Why? Because when you have a 3.5% 30-year fixed rate mortgage in your home and you want to remodel your kitchen, which you don't have the cash to do, you're going to do a home equity line of credit to fix your kitchen or basement or bathroom. Well, if you're going to pay 7% in interest on this home equity line of credit when you have a 3.5% mortgage, doesn't seem very enticing. And so you have a lot of people that are waiting for interest rates to go down. That way they can go out and borrow money from the bank. That way they can then go and take this money to Home Depot and Lowe's so they can buy the materials to fix up their bathrooms, their basements, or something else in their home. And so this is the situation that we're in. We live in the spending-based economy that is fueled through debt. And in order to keep people spending, in order to keep the economy moving, the Federal Reserve Bank has to adjust interest rates, which adjusts how much money people spend that they don't have. If you don't live off of debt, none of this really matters because this just changes how people spend their money. But if you're not operating with debt, the only thing this affects is the amount of interest you're going to be getting from your high-yield savings account. But let's continue to play this example out a little bit further because I want you to understand what are the implications of this. Because remember, inflation is still around. Inflation has been happening since long before the pandemic. It didn't start during the pandemic. The Federal Reserve Bank wants inflation to happen. The United States government wants inflation to happen. And you might say, well, Jaspreet, how do you know that? Remember, the Federal Reserve Bank says that they want 2% inflation. They don't say that they want 0% inflation. They don't say they want negative inflation. They say they want 2% inflation. What does that mean? It means that the prices of things are rising slowly, that the average person doesn't notice it day to day. Now, why would the government want inflation? The government wants inflation because they have $35 trillion worth of national debt. And inflation means that the value of the dollars are dropping. which means the value of this $35 trillion worth of debt goes down because the government can then pay it back with cheaper dollars. They essentially want to inflate away the value of this debt. Because you can imagine that if we were seeing deflation, which is the value of a dollar getting stronger, that means the government would have to pay back $35 trillion worth of national debt with more expensive dollars. They don't want that. Now, for the average person, you don't want to see inflation because the average person is a consumer. Inflation as a consumer means that you got to pay more money to buy your groceries. You got to pay more money to buy a car. You got to pay more money to buy a home. You got to pay more money to go on a vacation. And most people are only consumers. Every single person is a consumer, but most people are only consumers. Some people become investors. Investors benefit when you have inflation because inflation means that more dollars go into the hands of businesses that the investors own. And inflation also helps the value of asset prices rise. Over the last 5 years, we've seen inflation happen, which has caused the prices of things to rise faster than wages. But the S&P 500 has grown even faster than that. The S&P 500 has grown faster than people's incomes. The S&P 500 has grown faster than expenses. So wealthier people who are investing their money into the markets have become wealthier because of inflation, while the average person has become poorer because the average person is an employee and they are a consumer. And so for the average person, if you are an employee and you are a consumer, that means your salary from your job doesn't stretch as far. If you make $50,000 a year today, that $50,000 a year cannot buy you as much as $50,000 could 5 years ago. So your $50,000 doesn't stretch as far. If you're saving that money and it's not getting a rate of return that's bigger than inflation, that means your savings are also buying you less stuff. $1,000 today in your bank account can buy you way less than what $1,000 could back in 2019. And if you are just a consumer, well, like I just said, that means that you are the one that's paying the higher prices. But if you are an investor, what does that mean? You own the assets. You can own Walmart. You can own Amazon. You can own the businesses that are selling the stuff. And so now if you are an investor, you're benefiting from inflation because now when Amazon sells their stuff for more dollars or Walmart sells their stuff for more dollars, you own a piece of those profits. This is why it pays to be an investor, because our economic system is designed to make investors richer. You don't have to be rich to start being an investor, but this economic system is designed to create inflation which benefits investors. We're not even getting into the tax laws because the tax laws benefit investors more than employees, but this is why now you got to understand that this system is designed to benefit investors. So now when you hear the Federal Reserve Bank is working to potentially cut interest rates to stimulate the economy, you might think that this is trying to help the average person because now you can go out and get a mortgage at a lower interest rate. You can go out and buy a car at a lower interest rate. So you can go out and buy more stuff. But is buying more stuff building more wealth? No. Buying more stuff is getting more liabilities, getting more debt payments. And this is where sometimes you have to go through that pain of realizing I can't afford this car. I can't afford this spending. I need to get my money right. I have to save up more money. When you have higher interest rates, people have to be smarter with money. Number one, because if you want to go out and finance a car, it is going to be more difficult for you to qualify. You're going to need more money. Number two, if you're going to invest your money, you have to be able to justify the returns. Because if you're borrowing money at 7 or 8%, you need a return that's bigger than 7 or 8% to justify that investment. But if you can borrow the money at 2%, you could throw your money really anywhere. And so when you have the lower interest rates, well, then you start to see more dumb money being thrown around because people can access more money. And then you start to see the growth of things like zombie companies. Zombie companies are companies that don't make money, but they're continuing to operate because they have access to a lot of debt and a lot of venture capital and a lot of angel capital because investors have just a lot of money to spend. And we saw a boom of zombie companies during the pandemic, which then many of them went bankrupt over the last 24 months as interest rates went up. And so we have to pay attention to the way that the economic system works, because anytime you cut interest rates, it is there to stimulate spending. And of course, there's a concern that if you start stimulating spending during a time where inflation is still hurting people, could that make the inflation problem worse? And of course, nobody knows what's going to happen for sure, but these are things we want to pay attention to. Because if interest rates go down, more people start buying cars, more people start buying houses, and that creates more demand, it creates more bidding wars. If that forces the prices of housing or cars or other goods to go up again, well, now we have the inflation problem we have to worry about again, in addition to an economic problem, because we already know that unemployment has been going upwards. Sure, 4.3% unemployment, reported unemployment that we have today, is historically very low, but it's a lot higher than where we were 12 months ago. And we've been seeing this trend where employers are hiring less people, they have smaller starting salaries, wage growth has shrunk, and employers are just generally pushing more efficiency because they're seeing what is changing in the economy. Not to mention the fact that there's been a lot of pressure on the Federal Reserve Bank to cut interest rates, particularly from commercial landlords, particularly from corporations, because these commercial landlords and corporations don't have 30-year fixed rate mortgages. They've had readjusting loans. And every single commercial landlord, every single corporation readjusted their debt back in 2020 and 2021 when interest rates were at the lowest levels ever. Well, 2024 is when those debts start to readjust. Meaning, if you are a corporation and you have $100 million worth of debt, you might only be paying 3 or 4% a year in interest because you could get that very cheap debt back in 2020 or 2021. And in 2024 or 2025, that debt might be readjusting. At what interest rate? Well, it's going to depend on what the Federal Reserve Bank does. But today, every corporation and every commercial landlord is saying, oh my God, I really don't want to have to pay 8% on this same debt because that's going to make our monthly payments double, even if we don't increase how much debt we have, just because the cost of servicing that debt goes up. So there's a lot of pressure on the Federal Reserve Bank because they're looking at this saying, yeah, if all these corporations and all these commercial landlords see their trillions of dollars worth of debt readjust at a much higher interest rate, we could be facing a major financial catastrophe. And that's what they want to avoid. Because if you are a corporation and your debt costs go up, you have to make enough money to continue paying all your bills and the higher debt costs. And what we've seen over the last 6 to 12 months is that corporations, at least some corporations, have faced a little bit more struggle to continue growing their brands just because they've been seeing a slowdown in spending, because they've been seeing more and more Americans run out of money. It's the same with commercial landlords. If you're sitting on an office building that you paid $100 million for, it's only worth $60 million today, maybe $40 million today, and it's half vacant, and now your debt costs are going to double. Well, now maybe instead of mailing in your next mortgage payment, you might just mail in the keys. And so you can imagine why there's a lot of pressure on the Federal Reserve Bank to start cutting interest rates sooner rather than later, because those big readjustments are supposed to start in 2024 and even more into 2025, which is why the Federal Reserve Bank has their eye on that, on these debt readjustments. They have their eye on unemployment going up, and they have their eye on inflation. Originally, the Federal Reserve Bank said that they're not going to cut interest rates until we see 2% inflation. But they changed their mind. Now they're saying they just want to see inflation heading towards 2% to then justify cutting interest rates. We are not at 2% inflation. But now the Federal Reserve Bank has made it essentially official that they're going to be cutting interest rates soon. How aggressively and how many times, we don't know. But Jerome Powell himself now says that it is time to start cutting interest rates, which is why you want to pay attention to this, because people can change their minds. The Federal Reserve Bank said that inflation was transitory. Then they said inflation is not transitory. Then they said they're not going to cut interest rates until we see 2% inflation. Now they're saying that we're going to cut interest rates because we're heading towards 2% inflation. And so now you just want to pay attention to all the things that are happening. Of course, we also have an election coming later in 2024, which impacts the Federal Reserve Bank. But what this means for you as a financially savvy investor is you don't want to try to predict what the Federal Reserve Bank does. You don't want to try to fight the Federal Reserve Bank, but rather understand what's happening in the economy. That way you can find the opportunities, because the reality is every single shift, every single piece of craziness in the economic system creates opportunities for those that are financially savvy. You also want to understand that markets go up and markets go down. It's the part of the economic system. People hope that markets only go up. People expect markets to constantly go up. But the people that really build wealth are the ones that understand that markets go down, and they're prepared to take advantage of opportunities when markets go down That way they can win when markets go down, they can win when markets go up, and they can also win when markets go sideways. But that requires you to, number one, be financially prepared. That means get rid of your high interest debts, build some cash savings to protect you, and have money to be able to capitalize on opportunities. Number two, be financially educated. Learn how to read a financial statement. Learn how to underwrite a real estate investment deal. Learn what it is that you want to invest in. Build an investing strategy. Do you want to invest in stocks? Do you want to invest in real estate? Do you want to invest in index funds, ETFs, or mutual funds? Do you want to invest in individual companies? Do you want to invest for dividends? Do you want to invest for growth? Understand your strategy. And then number three, pay attention to financial trends. You want to invest your money into industries where the money is moving into, not where the money is moving out of. And that requires you to pay attention to the different things that are happening. Of course, I'll be keeping you posted here on my YouTube channel. And we also work to keep you posted on market briefs. If you have not joined yet, I got the link for you down in the description. And with that, I will see you on YouTube tomorrow.